The one pattern trader. So what does it mean to be a one pattern trader? Well, I suppose the name kind of makes it fairly obvious, but it's a trader who focuses primarily on one and only one setup, right? A pattern can be a lot of things. It can be a moving average cross, a MACD setup, divergences. I mean, you name it, whatever you trade personally, but you're trading one setup. That's it. So the next question is then, does it work? Is this something that actually works? Is this something that you can do for long-term more than just short-term success? Patterns are always one of those things that work really well over like the next month. And then after that month, then it all goes to crap again. And that's because markets are constantly cycling. They're constantly changing. So firstly, when we're looking at a pattern, which is obviously what we're going to need, we need a pattern that is setting up in a way that is relatively repetitious and something that we can count on. That can be a lot of different things. It can be a wedge, the head and shoulders, a trend line. Again, you can use whatever pattern you want. But firstly, when you're looking and using one pattern trading, which by the way is totally fine, there's nothing wrong with it, but there are a few caveats. You can trade one pattern only and still do just fine. But there's a little bit of extra legwork that usually has to be done in order to make sure that it's actually going to work in your favor. So when you are trading only one pattern, right, just one thing, you are no longer trading markets with context. There's no such thing as context when you're just strictly a pattern trader. At that point, you're kind of like a computer, really. And the idea behind that is that it's the pattern or not the pattern. It's a 1 or a 0. It's either a yes or a no. So the rules have to be really, really solidified in terms of that one pattern. You have to know exactly what it's supposed to do, when it's supposed to do it, how it's supposed to do it, and then you can execute. So since that's the case when we're dealing with more probabilities and not so much of the context side of things, we have to understand that the probabilities are where our long-term success or failure is going to lie. We really have to understand our probabilities as pattern traders. So patterns are, just like everything else in the market, fallible. They can, and I promise you, they will fail. So with that in mind, we have to kind of approach it with a pattern trader's mindset. We always have to maintain a 2-to-1 risk or reward versus risk, depending on how you say those, better reward than your risk to ensure that the gains outweigh the losses, because we're dealing with a pattern. We're dealing with probabilities. We're not dealing with discretionary scalping or anything like that. And since that's the case, every pattern has to be approached with that high reward versus risk mentality. And that's where inherently the probability of success in the long run is going to see the best benefit. Not so much the short term, but in the long term, because we're dealing with a lower probability setup, it's assumed we're probably floating around like the 40% range in or around that area. So if we're approaching them with that large reward versus risk, typically like a 2-to-1, if you were assuming a 2-to-1 type setup and it's a 40% accuracy, that's great. That's totally fine. In fact, it offers a really good trader's math of a positive 2,000 over 100 trades, which is fantastic. If you're not sure what that is, I do a bunch of other videos on trader's math as well. But it's a very, very good situation to be in. But 40%, that's the tough part, right? As a human, we're not a machine. We have emotions, we have feelings, we do things because we're humans. We're dumb sometimes, we're smart sometimes. We have our moments, you know? And as a human, approaching this pattern trading can be a little bit more difficult because as a pattern trader, you really have to stick to the rules as much as possible. It's imperative that you stick to those rules every single time. Because realistically, as a pattern trader, you're relying on those long-term probabilities to seek out that long-term success. And that means that long-term probabilities, well, they come from somewhere. They come from the wins and the losses. And that means you got to take them all. And that's just the way that it works. Faltering on the management or entering a trade or whatever, it's almost like scrapping the entire system. You've just thrown it to the side. So with a pattern trader, we always have to be calculating our trader's math, at least once a week, maybe a couple times a week, probably not that often though. Every week, every month, and really what we're looking for is to ensure that the conditions that the market is offering us are still favorable for our setup. Our trader's math is positive. And as long as it is, as long as it's still working correctly, then the trade setup's applicable. You keep going, right? You keep doing it over and over and over again. Now, eventually, like we were talking about, the market cycles. And eventually, the pattern that you're looking at right now, which is working fantastic, will stop working. When the market no longer supports the pattern that you're using, Don't throw it away. Markets cycle. It will come back into favor at a later time. You just have to give it a little bit more time to go through the cycle. What you have to do now, and this is one of the caveats of being a pattern trader, you have to adjust your pattern to the new market with maybe some modified rules of entries or modified exits or whatever you need to modify, but something to modify it in a way that it actually is, working in your favor to the new market context. Sometimes it only takes a little tweak, but that's the point. You're using the same pattern. You're modifying it a little bit based on current market conditions. And then once that market condition dies off again, and once it stops and ceases to keep doing that, it'll probably flex right back into the one it was doing before, the one you started with. And the beautiful thing about that as a pattern trader, at least, is that you're able to kind of flex in, flex out, as long as the trader's math is positive. If you see the trader's math start waning, then you start introducing another strategy to compensate it, and they all come together and create a nice uniform balance. That's going to do it for today's video. Like we always say, stay safe out there. Keep those stops in play and let the winners run. Hopefully found the video useful, something interesting, entertaining you can add to your tool belt if you haven't already. And until the next one, have a good time and have a good day, and I hope you have a great trading time as well. So that's going to do it for this one. Like we always say, stay safe out there, keep those stops in play, and let the winners run. Until the next one, I hope you have a fantastic trading day, and we'll see you all then. Thanks.